He did not grab the cheapest policy he could find. He researched, he compared plans. He picked the company with the highest customer satisfaction rating in his state. He paid his premium every single month without missing one. And then a driver ran a red light at 47 miles per hour and hit him. His car was totaled. He had a torn ligament in his knee. He missed 11 weeks of work. And his medical bills came to $74,000. His insurance company paid $25,000. Cole thought he had full coverage. He did not know what full coverage actually means. Nobody told him. And that gap between what he thought he had and what he actually had cost him $49,000 out of pocket. Now meet Daniel. Daniel did not research anything. He picked his policy in 12 minutes on his phone. He grabbed what his state required and added one thing his agent recommended. He spent $40 less per month than Cole. 6 months later, Daniel rear-ended someone on the highway. The other driver had $180,000 in medical bills. Daniel paid nothing out of pocket. Not $1. Same roads, same risk, very different outcomes. The difference was not luck. It was one number buried in their policies that almost nobody checks. Professor Wealth ran the numbers on both. Here's what your insurance company does not highlight in the brochure. Cole's first mistake was a phrase, full coverage. It sounds complete. It sounds like a wall between you and financial disaster. It is not a wall. It is a marketing term. It has no legal definition. No state requires it. No regulator enforces it. It means whatever the salesperson wants it to mean. In practice, when most people say full coverage, they mean three things combined: liability, collision, comprehensive. Liability pays for damage you cause to other people. Collision pays for damage to your own car when you hit something. Comprehensive covers theft, weather, animals, and falling objects. Cole had all three. So yes, technically he had full coverage, but here's what full coverage does not tell you. It does not tell you how much liability you actually have. It does not tell you what happens when the other driver has no insurance. And it says absolutely nothing about what happens to your income while you are lying in a hospital bed unable to work. Cole checked the boxes. He did not read what was inside them. Every liability policy has two limits: a per person limit and a per accident limit. Cole's policy said $5,100. That means $50,000 per person injured and $100,000 per accident total. Sounds reasonable. Most people would look at that and think that is solid. Here is the problem. The average emergency room visit in America costs $3,100. A single night in the hospital costs $11,700. Surgery for a serious injury runs anywhere from $30,000 to $150,000. Physical therapy for months of recovery adds another $10,000 to $40,000. If Cole had seriously injured the other driver, someone who needed surgery, hospitalization, and 6 months of rehab, the total medical bill could easily hit $200,000. Cole's policy covers $50,000 of that. The remaining $150,000 comes from Cole personally. His savings, his wages, his assets. A judgment can follow him for years. And here's what makes this worse. The Insurance Research Council found that drivers with state minimum liability coverage are involved in 3 times more underinsurance claims than drivers with a higher limit. Not because they are worse drivers, because when something goes wrong, the person on the other side discovers the coverage is too thin and the legal system fills the gap by going after the driver directly. Cole thought $5,100 was generous. In a serious accident, it is a starting point, not a finish line. Now, here's the part that actually explains Cole's $49,000 gap. The driver who hit him ran a red light at 47 miles per hour. That driver was at fault, 100%. So Cole's own insurance should not matter, right? The other driver's liability coverage should pay for everything. Except the other driver had the state minimum, $25,000 per person. That is it. That is the entire policy. Cole's medical bills were $74,000. The other driver's insurance paid $25,000. And then it was done. Legally done. Policy exhausted. Cole had 2 options: sue the driver personally or use his own insurance to cover the rest. The driver had no assets worth pursuing, and Cole's own uninsured motorist coverage was set to the minimum his insurer offered, $25,000, which the other driver's insurance had already matched, so Cole's own coverage paid $0, because it only kicks in above what the at-fault driver already paid, and the at-fault driver paid exactly the same amount. Cole had the coverage. He just had it set too low to matter. This is the number Daniel's agent told him to increase. That one conversation 4 minutes maybe was the difference. Daniel had $100,000 in underinsured motorist coverage when he rear-ended the other driver and their bills hit $180,000. Daniel's liability covered the gap. His rate was $40 cheaper per month than Cole's, but his actual coverage was 4 times stronger where it counted. Cole missed 11 weeks of work. He is a project manager. He makes $72,000 a year. 11 weeks is roughly $15,000 in lost income. His health insurance covered most of the medical bills eventually. After deductibles and copays, he paid about $8,000 out of pocket on medical. But his car insurance paid nothing toward his lost wages, not $1, because standard auto insurance does not cover your lost income unless you have something called personal injury protection or medical payments coverage. Cole's policy had neither. He did not know he could add them. He did not know they existed. Personal injury protection is required in 12 states and optional in most others. In states where it is optional, most insurers offer it and most buyers skip it. Because nobody explains what it does, personal injury protection covers your medical expenses and a portion of lost wages regardless of who caused the accident. You do not wait for fault to be determined. You do not fight with the other driver's insurer. You file with your own company and get paid. On Cole's income, adding personal injury protection with $50,000 in coverage would have cost him approximately $18 to $35 more per month. He missed 11 weeks of work. That is $15,000 in lost income. The cost to prevent that loss was between $216 and $420 per year. Cole had the highest rated insurance company. He just had the wrong policy structure inside it. Here's why Cole chose his insurer in the first place. J.D. Power ranking. Top rated in his region. AM Best Financial Strength rating, a plus, consumer satisfaction score, 4.6 out of 5, all real, all legitimate, all completely irrelevant to whether his specific policy would protect him. Here's what those ratings actually measure. J.D. Power measures customer satisfaction, how happy people felt about their experience, friendly agents, easy app, quick responses. AM Best measures financial strength, whether the company can pay its claims, not whether your claim will be large enough to matter. Consumer satisfaction scores measure the average experience. The average claim is a fender bender, a broken windshield, a minor collision. For small claims, high-rated insurers are genuinely better. They respond faster, they process smoother, they communicate clearly. But a catastrophic accident is not an average claim. And the rating system is not built to measure what happens when you need $200,000 and your policy only covers $50,000. The rating tells you the company is good at paying what they owe. It does not tell you whether what they owe is enough. Cole optimized for the wrong variable. He picked the best company to execute a policy that was not built to protect him. Here's the actual framework. Simple. 3 things. Number 1, set your liability limits correctly. The standard recommendation from independent financial planners is 100, 300, 100. $100,000 per person, $300,000 per accident, $100,000 in property damage. If your net worth is above $500,000, consider an umbrella policy on top. A $1 million umbrella policy typically costs $150 to $300 per year. It sits above your auto and home liability and covers everything above your base policy limits. Number 2, match your uninsured motorist coverage to your liability limits. Whatever you choose for liability, match it for uninsured motorist coverage. If you have 100 and 300 liability, have 100 and 300 uninsured motorist coverage. This is the single most underused lever in auto insurance. 1 in 8 drivers in America is uninsured right now. According to the Insurance Research Council, that number is rising. In some states like Florida, Mississippi, and New Mexico, it is closer to 1 in 4. You are statistically likely to encounter an uninsured or underinsured driver at some point in your driving life. When that happens, your uninsured motorist coverage is the only thing standing between you and paying for someone else's mistake with your own money. Number 3, add personal injury protection or medical payments coverage if your state offers it. If your state requires it, read it, understand the limits. If your state makes it optional, price it. It is usually inexpensive. $10,000 in medical payments coverage typically adds $5 to $15 per month to your premium. $50,000 in personal injury protection where available adds $15 to $40 per month. Compare that to 1 emergency room visit. Compare that to 1 missed paycheck. The math is not close. Cole was paying $147 per month for his policy. The adjustments above would have brought his premium to approximately $189 per month, $42 more per month, $504 more per year. His out-of-pocket loss from the accident was $49,000, and the coverage that would have prevented most of that loss cost him less than $1.40 per day more than what he was already paying. He did not skip it because he could not afford it. He skipped it because nobody showed him the math. Cole did everything the brochure told him to do. He picked a reputable company. He paid on time. He chose what sounded like real protection. And when it mattered, when a stranger ran a red light and changed the next year of his life, his policy did exactly what it was designed to do. It just was not designed to protect Cole. It was designed to meet the minimum Cole would accept without asking questions. Daniel spent 12 minutes picking his policy, but those 12 minutes included one question his agent answered honestly. What happens if the other driver is not covered enough? That one question was worth $49,000. Your insurance premium is not the number that matters. The number that matters is the one buried 3 pages into your declarations page. Pull it out. Check your liability limits. Check your uninsured motorist coverage. Ask about personal injury protection. The company rating tells you they will pay. It does not tell you how much. And in the worst moment of your driving life, that difference is everything. If this video showed you something you did not know was sitting inside your